Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way.
Yeah, we've got a really fascinating topic today.
We really do. So, imagine a force so powerful that it can basically veto the president of the United States.
Right. Or, fire a prime minister.
Exactly. And it dictates the price of your monthly mortgage overnight, all without a single vote ever being cast.
Pretty wild when you think about it like that.
It really is. So today we are taking a deep dive into the global bond market because, for an everyday American, it can feel like this invisible, complicated thing.
Oh, absolutely. I mean, for a long time, it felt like this market was just asleep.
Right, like governments could just spend whatever they wanted, run up trillion-dollar deficits and, well, face zero consequences.
Yeah, but looking at recent analysis for 2026, the bond market has definitely woken up.
It's awake, and it is acting as this brutal, strict disciplinarian for basically every major economy on Earth.
Yeah, the entire financial regime of the world has just flipped upside down over the last few years.
So to understand where we are right now, we kind of have to look back at the 2010s, right?
We do, because during that decade, governments essentially had a completely free pass to borrow and spend.
Because inflation was it was practically non-existent.
Exactly. And central banks were doing quantitative easing, or QE. They were essentially, creating trillions of dollars out of thin air.
Just to buy up massive amounts of government debt.
Right. And because the central banks were acting as this guaranteed bottomless buyer, borrowing costs were artificially crushed down to basically zero.
So investors just got completely conditioned to believe that ultra-low interest rates were forever.
Yeah, like it was a permanent law of physics in the modern economy.
It's like, think of the 2010s bond market less like a responsible financial system and more like a teenager with a credit card.
Oh, I like that analogy.
Right. So in the 2010s, the central bank was the rich parent. And they're just quietly paying off the bill every single month so the teen can keep spending wildly.
And the actual private investors never really felt the pain of that spending. They just enjoyed the ride.
Exactly. But based on the data, in 2026, the rich parent cut them off. The CFO slammed the printing press shut.
Yeah, inflation completely shattered that dynamic. The inflation we're dealing with now isn't just a temporary blip. It's deeply structural.
Right, because we're looking at ongoing geopolitical conflicts, massive energy price shocks.
Plus, a global surge in defense spending and supply chains being entirely rewired.
Which costs an immense amount of money. And central banks can't easily control any of those things.
They can't. So because this inflation is so stubborn, central banks can no longer act as that bottomless buyer.
Which means the teenager has to go to a real bank to ask for a loan.
Right. Governments now have to sell their massive piles of debt to actual private investors. Pension funds, insurance companies, everyday people.
And those private investors are looking at the sheer volume of new government bonds flooding the market.
Yeah, bonds needed to pay off post-pandemic debt, fund green energy, build infrastructure.
And the investors are basically saying, we're going to need a massive premium to take on that risk.
Exactly. By May of 2026, that overwhelming supply triggered a massive global sell-off.
Pushing the average 10-year borrowing costs for G7 nations super close to 4%.
Yeah. So a government can announce whatever grand policy they want. More welfare, industrial subsidies, whatever.
But the bond market immediately runs the math.
Right. It asks this very cold, calculating question. Who is actually going to buy the debt to fund this? And at what interest rate?
And if the market decides the math doesn't add up, it demands an astronomically high rate.
Which basically makes the policy financially dead on arrival.
Okay, wait, before we go further into the global stuff, we really need to clarify a core mechanic here.
Sure. What's that?
Well, it trips up almost everyone listening to financial news. We keep talking about a massive sell-off, meaning bond prices are dropping.
Right, prices go down.
But at the same time, we're talking about borrowing costs and yields hitting 4% or 5%.
Yeah.
So why do yields go up when prices go down?
It's honestly the most counterintuitive concept in finance, but it makes perfect sense when you break it down.
Okay, lay it on me.
So imagine you buy a government bond for $100, and it promises to pay you a fixed coupon of $2 every year.
Okay, so that's a 2% yield. Simple enough.
Right. Now imagine inflation spikes, and the government has to issue brand new bonds that pay $5 a year just to attract buyers.
Okay. But my old bond still only pays $2.
Exactly. So if you try to sell your old bond to another investor, they're going to laugh at you.
Because why would they pay $100 for my 2% bond when they can get a new one that yields 5%?
Exactly. The only way you can convince someone to buy your old, low-paying bond is if you drastically slash the price.
Oh, I see. I have to sell my $100 bond for, say, $70.
Precisely. So as the required yield in the market goes up, the actual cash value of the existing bonds just plummets.
Wow. Okay, the math really is entirely unforgiving.
It is. And this brings us right to the epicenter of the global financial system, the U.S. Treasury market.
Right, because the U.S. Treasury yield is basically the absolute baseline for all global asset prices.
It's the discount rate for the world. When the U.S. 10-year or 30-year yield goes up, it pulls the cost of everything else up with it.
Mortgages, car loans, corporate debt, even the stock market.
Yep. And right now, according to the data, the U.S. Treasury market is facing immense pressure from three distinct directions.
Let's break those down, starting with the Federal Reserve itself.
Right. The central bank is no longer coming to the rescue with cheap money.
Yeah, recent analysis shows under Chair Kevin Warsh, the Fed has executed a really hawkish pivot.
Yeah, in June of 2026, the Feds froze their benchmark rate at 3.50% to 3.75%.
But the big detail was they aggressively raised their late 2026 inflation projections, right?
Did. From 2.7% all the way up to 3.6%.
Wow.
And the market is interpreting Warsh's style as very reminiscent of the strict, principle-driven Fed of the 1990s.
So he's basically signaling that the Fed won't hesitate to hike rates further if inflation stays hot.
Exactly. He is laser-focused on price stability.
Okay, so if the Fed is pulling the punch bowl away, who is stepping in to buy the debt? Because we've got massive structural deficits right now.
That's the second massive pressure point. The supply of new bonds is just overwhelming the system.
And it doesn't even matter that President Trump is in the Oval Office now, right?
No. The current economic policies or the administrations before him, the cold reality of the national balance sheet is the same.
The government is rolling over old debt and borrowing heavily.
Yeah. And while the U.S. holds the world's reserve currency, meaning there's virtually no risk of actual default, they still have to convince private capital to absorb this ocean of bonds.
And the data shows the sheer volume of this borrowing pushed the 30-year U.S. Treasury yield to over 5.1% in May 2026.
Which is the highest level we've seen since 2007.
Over 5% on a 30-year bond is just staggering, especially when we were near zero just a little while ago.
It's a massive shift.
Now, the research highlighted a third pressure point, and it involves something called duration hedging.
Ah, yes. Duration hedging.
Yeah, let's unpack that, because it sounds like Wall Street jargon specifically designed to confuse everyday people.
It totally does, but it's actually a very mechanical chain reaction. And it's driven entirely by the mortgage market.
Okay, how so?
Well, imagine a massive institutional investor holding billions of dollars in 30-year fixed-rate mortgages.
Right.
In a normal environment, a certain percentage of homeowners will sell their house or refinance every few years, which pays off those mortgages early.
Sure, people move all the time.
But when general interest rates suddenly spike, mortgage rates spike with them. So homeowners look at their current low-rate mortgage and decide they are never moving.
No, they refuse to sell. They're locked in.
Exactly. Which means the institutional investor is suddenly stuck holding those low-yielding mortgages for much, much longer than they planned.
So the duration of their investment has artificially extended.
And the value of their portfolio is tanking.
Yeah.
Because, like we said earlier, holding a low-yield asset in a high-yield world destroys its price.
Right, the $70 bond scenario. So what do?
To protect themselves, these investors have to hedge. And they do this by aggressively shorting or selling off U.S. Treasuries.
Oh, wow. But wait, if every major mortgage investor realizes this at the exact same time?
They all rush for the exit simultaneously. They just dump Treasuries into the market.
And that massive wave of selling naturally pushes Treasury prices down even further, which forces yields up even higher.
Exactly. It becomes this vicious, self-fulfilling feedback loop.
And that dynamic helped drive the 10-year Treasury yield up to 4.69%, right?
Yeah, the highest since January 2025.
You know, this completely shatters a narrative I've heard my entire life.
Which one?
I was always taught that U.S. Treasuries are the ultimate, rock-solid safe haven. Like, if the stock market crashes, you buy long-term Treasuries because they're safe.
Yeah, the definition of safe haven has fundamentally changed.
Are you saying they're risky now?
Well, when people call U.S. debt safe, they mean the government will physically deposit the interest payments into your account. The U.S. won't default.
Okay, that's good.
But the price of these long-term bonds is incredibly volatile today. They are not a low-fluctuation, risk-free asset anymore.
So if inflation stays stubborn, the daily market value of my bond could just collapse.
Absolutely. Their value swings aggressively based on global inflation data and government deficit projections.
Okay, so if the U.S. needs to borrow trillions of dollars and they're suddenly forced to pay 5% to attract buyers, it begs a massive question.
Who are the buyers keeping these rates so low for the last decade?
Exactly. Where did the cheap money actually come from?
The hidden pillar of the entire global bond market has always been Japan.
Japan. Okay, let's talk about Japan.
For decades, the Japanese economy was trapped in this relentless cycle of deflation.
Right, prices were falling.
So to combat this, the Bank of Japan, the BOJ, forced their domestic interest rates down to zero, and sometimes even negative.
So they effectively flooded the global financial system with incredibly cheap yen.
Yes, it created a global arbitrage machine known as the yen carry trade.
Okay, I like to think of Japan here as basically a generous roommate who always lent you cheap cash.
That's a perfect way to look at it. Japan was handing Wall Street a zero-interest credit card.
So institutional investors would borrow billions of Japanese yen for practically nothing.
Right. Then they convert it into U.S. dollars and buy higher-yielding U.S. treasuries or European bonds.
Wow. So they're just pocketing the interest rate difference with almost zero risk.
Exactly. And this massive constant demand for U.S. debt from overseas buyers is what kept global borrowing costs so artificially low.
It was a perfectly balanced system until the foundation cracked.
Yeah. In June 2026, the BOJ fundamentally changed the rules of the game. They raised their base rate to 1.0%.
Which to an American, 1% sounds like literally nothing.
But in Japan, that is a shocking 31-year high.
Wow.
And former BOJ board member Sakurai recently projected that Japanese rates could reach 2% by early 2028.
But why? Why is Japan suddenly abandoning decades of zero-interest policy right now?
The weakness of the yen finally forced their hand. Japan is an island nation, right?
Yeah.
They import almost all of their energy and a massive portion of their food.
So when the yen is weak against the US dollar, buying those commodities becomes devastatingly expensive.
Exactly. It imports massive inflation directly into the Japanese economy.
So to protect their currency, the BOJ really has no choice but to raise rates.
But the moment Japan starts charging real interest on that credit card, the global arbitrage machine breaks down.
Ah. Because if a Japanese investor can finally get a 1% or 2% return safely at home,
The margin they make by taking on the risk of buying U.S. bonds collapses. They unwind the trade.
so the generous roommate finally needs their money back for themselves.
Precisely. They sell their U.S. treasuries, convert the dollars back to yen, and bring their capital home.
And when the biggest buyer of last resort steps away, the U.S. government has to offer even higher yields to entice whoever is left.
Which reshapes the entire world.
Man, if financial superpowers like the U.S. and Japan are facing this much pressure, what happens to countries that don't have that level of dominance?
The pressure on them is far more severe. If you look at the data, the European bond market is currently a masterclass in market discipline.
Because Europe isn't just one single interest rate. Right?
Exactly. The market heavily fragments the Eurozone based entirely on trust.
I like to use a credit score analogy for this.
Go for it.
So Germany and France both use the exact same currency, the euro.
Right.
But Germany acts like a borrower with an immaculate 800 credit score.
Yes, their finances are traditionally very disciplined.
So they're the rock-solid anchor. And the market gave their 10-year bond a yield of around 2.957% in June 2026.
But France, on the other hand, is acting like a borrower whose credit score is dropping into the 600s.
Because the IMF warned that France's deficit is hitting 5.1% of their GDP for 2025.
Yeah, they're structurally failing to get it under the mandated 3% target.
So the market looks at France and says, we're going to charge you a massive trust premium to lend to you.
Exactly. Investors refuse to treat the Eurozone as a single entity. They ruthlessly price in fiscal irresponsibility.
And if we look across the channel, the UK is essentially the canary in the coal mine for this whole phenomenon.
Oh, the UK is the most extreme example. In May 2026, their borrowing shocked the market by hitting £23.3 billion.
And their 10-year yield spiked to 4.8%.
The bond market is punishing their fiscal trajectory with brutal efficiency.
Okay, let's follow this chain down to its most vulnerable point, the emerging markets.
It's absolutely devastating for them. They face a terrifying capital flight doom loop.
Because if the U.S. Treasury is paying 5%, why would anyone take the risk of holding debt in an emerging market?
Exactly. Investors pull their capital out of those developing countries and flood it back into the U.S.,
And when that foreign money flees, the local currency of the emerging market just collapses.
which means everything at import oil, food, medicine suddenly doubles in price.
Creating hyperinflation. So then their central bank is forced to aggressively hike their own interest rates just to convince foreign capital to stay.
Sometimes to 10% or 15%. So
Mhm.
suddenly their borrowing costs are astronomical. NAD, their local economy, is suffocated.
A brutal double threat. Only countries with massive foreign reserves can survive that.
Yeah, it's a very harsh reality.
Okay, so this brings us to the ultimate question for you, the listener. How does this intricate web of global bond mechanics actually affect an everyday American's portfolio?
Well, according to recent analysis, the most critical paradigm shift is changing the primary question you ask.
What do you mean?
The defining question is no longer, what is the central bank doing at their next meeting?
Oh, interesting.
The only question that matters now is, who is going to show up to buy the government's bonds at the next Treasury auction?
Wow, so bond auctions are now just as important as Fed meetings.
Absolutely. Because a weak bond auction instantly spikes yields, and that shockwave hits every asset in your portfolio.
So what are the practical takeaways for someone just trying to manage their retirement account in 2026?
The research lays out 4 fundamental rules. First, we have to abandon the idea that long-term bonds are an automatic safety net.
Right, because if an inflation shock crashes the stock market, your long-term bonds are going to crash right alongside your stocks.
Exactly. The historical negative correlation breaks down when inflation is the culprit.
That's rule one. What's the second takeaway?
The second rule fundamentally changes how we value companies. Stock values are mathematically tied to bond yields.
Because if the U.S. 10-year is hovering around 4.5% or 5%, high-growth stocks suddenly look way less attractive.
Right. Why wait 10 years for a tech company to hopefully turn a massive profit when you can get 5% guaranteed from the government today?
So the higher the bond yield goes, the harder those future promises are discounted.
But on the flip side, companies that generate massive tangible cash flow right now, like energy producers or major banks, suddenly look much better.
That makes a lot of sense. What about the third takeaway?
The immediate vulnerability of real estate and private equity.
Oh, because those industries rely on massive amounts of cheap debt to buy properties and build infrastructure.
Right. If a developer modeled a new project, assuming a 3% borrowing cost, and suddenly loans cost 7%.
The profit margin vanishes. The deal just dies on the drawing board.
Exactly. Which brings us to the final reality for investors. Diversification is exponentially harder today.
So the classic portfolio of 60% stocks and 40% long-term bonds, that's structurally flawed right now.
It really is. Protecting wealth today requires a mix of short-term government bills, inflation-linked securities, cash-flowing defensive stocks, and maybe physical assets like gold.
You really can't just buy a single long-term bond and forget about it anymore.
No, you can't.
You know, I think there's a really profound realization hidden in all these numbers. I loved this quote from the data. The bond market doesn't punish political ideology. It punishes bad math.
It's the absolute truth. It doesn't care if a policy leans far to the left or far to the right.
It only cares about the balance sheet.
Right. If a government can't mathematically prove they have the revenue to support their spending, the bond market will refuse to fund it.
It's the ultimate reality check.
Yeah, we're leaving an era of unlimited spending and entering an era of absolute fiscal gravity.
The ultimate price tag. So if there is one final provocative thought you should take away from this deep dive, it is this.
Yeah, next time you hear a politician, local mayor, or the president promise a massive new spending project,
Don't just ask if it sounds like a good idea.
ask yourself, at what interest rate will the global bond market actually allow them to fund it?
Because in 2026, the bond market always gets the final word. Thank you so much for joining us as we explored the hidden gears of the global economy. Don't forget to subscribe and hit that like button.